Hello, everyone. My name is Julian Sanguidolci, Head of Institutional Sales with CFRA Research. I'd like to welcome you to today's webinar, Cash Flow, Why Location Matters. Before we get started, I want to remind you that today's session is being recorded, and a link to the recording will be made available within the next few business days. During today's session, you may submit questions using the GoToWebinar panel, and we will do our very best to answer as many of these questions as we can. During today's session, my colleague Jennifer Latz will highlight the implications of accounting standard changes, reverse factoring, and how these arrangements can skew quantitative screens along with your analysis of cash flow and/or net debt. We will also review a few case studies of companies engaging in both the sale of receivables and supply chain financing, highlighting their differences in disclosure and the effect on various ratios for analysis. If we could go to the next slide. For those of you who may not be familiar with CFRA, very briefly, we're an independent research house, not a broker-dealer, no asset management services, who was founded 25 years ago, really to find companies using accounting tricks to mask deterioration in their business. You'll also see here in 2006, Legal Edge was added to round out our forensic equity research product to help clients understand how legal regulatory issues could be a positive or negative investment thesis. You'll also see in 2016, we acquired S&P's equity research business, which really added a lot of deep fundamental research to our firm's capabilities. On the next slide. So I say all that because we have a team of 25 analysts that are organized by sector and geography who are scrubbing financials from Asia Open Monday to US Close on Friday, trying to identify underappreciated financial statement and legal risks. Our real goal is to help our clients with a couple things. Security selection, to help them mitigate unforeseen risks, of course, generate alpha, and be an educational partner to understand any changing accounting standards in legal situations. On the next slide, we'll talk just a little bit about, give you a sense for our research output. Regarding the output, you can expect company-specific and both industry thematic research from our forensic research team that is complemented by deep fundamental expertise via our industry surveys. We also have a bespoke team that takes incoming requests, and if we turn to the next slide, our bespoke team / advisory team is in addition to our proactively published research. Our clients take advantage of our custom research and advisory team to address a whole range of questions, but some being complex accounting questions, how they're changing, to do deep dives on potential or current portfolio companies. And a lot more lately, we've been providing educational seminars / training, which today's presentation is a small snippet of. So if we can go to the next slide. And before we dive in here, I'd like to just quickly introduce Jennifer Latz. Jennifer is a senior analyst on CFRA's European research team, as well as leading its consumer retail research efforts. Prior to joining CFRA, Jennifer worked in the New York office of Ziff Brothers Investments for 5 years, and before Ziff Brothers Investments, Jennifer performed financial due diligence for KPMG's Transactory Services Group. She holds a master's in professional accounting from the University of Texas at Austin and a BA from the University of Michigan. So with that, I'd like to turn it over to Jennifer to begin our presentation, and thank you everybody again for joining.
Thank you, Julian. So today we're covering two types of cash flow arrangements that we see. The first is selling receivables. So we'll go through this technique, including a case study on Kraft Heinz and Dia, and we will then cover at a high level the new accounting standard in the United States that governs cash flow location treatment for the securitization of receivables. This is known as ASU 2016-15, and Teva is the company that we will use to highlight the change in accounting. The second technique that we'll go through today is reverse factoring, or the sale of payables, and we will do 3 high-level case studies on Kellogg, General Mills, and Sinopharm, each of which demonstrate the varying level of disclosure that we see in these cases. And then lastly, we'll discuss a company currently on our biggest concerns list where reverse factoring is heavily employed. And so for those of you who are not familiar with the biggest concerns list, these are names that we highlight to clients where we see significant downside risk over the next generally 1 to 6 quarters. But just in taking a step back from the agenda, I mean, we more generally focus on how companies perpetuate cash flow distortion or shenanigans through 4 different methods: geography, where something is in the cash flow statement. Number 2 is the timing. Third is non-GAAP metrics, and fourth is fraud. And so today we're really going to be focusing on the first 2, the geography of where something is in the cash flow statement, and then secondly, the timing and how that can be skewed by some of these techniques that we're covering. And so in terms of the 4 general things that we talk about with cash flow shenanigans, we have full and half-day seminars that go into some of these into more detail. So on the next slide, I think before we go into the definitions of the techniques, it's just important to understand why we think it's even important to discuss this, why we're here. I think first, on the sale of the receivables, there are 3 metrics that can be potentially skewed by the sale of receivables. The first is collection efficiency, which is usually manifested as days sales outstanding, or DSO. The second is cash flow metrics, cash flow from operations and free cash flow. And again, depending upon the geography of where these are going to be recorded. And then lastly, in terms of the sale of receivables, it can skew net debt to investors. And on the new rule, why does this matter? Why are we talking about it? It's impacting how people are screening, particularly across geographies, as the rule does not apply to IFRS. And so the cash flow from operations and free cash flow metrics have changed in the United States as a result of this rule. And secondly, the choice of financing, or in some cases, a choice that the bank forces the company to use, is now dictating where the geography is within the statement of cash flows, which we really don't agree with. And on the next slide, for reverse factoring, there are also risks. I think the first is just unappreciated credit risk, the masking of debt from using this technique. The second is also boosts the cash flow that may not be sustainable. And third is potential overstatement of the cash flow from operations. In some cases, it can be permanent, and we'll go through one example where that's the case with Sinopharm. And then lastly, the supplier payment terms are skewed and give investors a misleading view of the days payable outstanding. And I think especially with the supplier financing, we've seen recently that there have been some companies in the news as a result of using these tactics, including Carillion, and before that, Abengoa. So on slide 12, we'll start with the sale of receivables. What is this? It's an arrangement where a company is selling its receivables to a bank or financing company so it can get its cash more quickly. And in terms of how we screen for these arrangements, we tend to use some of the following terms: discounting, selling receivables, receivable securitization, often using the terms recourse and non-recourse, which we'll go through in a little bit, can also be helpful in terms of screening. The mechanics of this is that the receivables are sold to some third party, and the arrangements really vary depending upon the company's credit rating and the bank. So the discount rate, who's ultimately collecting and bearing risk, can vary widely. And why would a company do this? This is allowing them to free up capital, allows for longer payment terms. In Kellogg's case, it was done in response to a discrete customer that had asked about that. And also this helps a company flatter its cash flow and DSO metrics, particularly in the case of non-recourse or what we also see as derecognition. And so on the next slide, we'll go into a little more detail on what the recourse versus non-recourse or recognition versus derecognition means. And so if a company is selling their receivables with recourse, they're generally retaining some type of a risk of default. And the accounting entry is a debit to cash and a credit to some type of loan or finance instrument. And the cash flow impact increases the company's cash flow from financing. And generally we find this, just in terms of analysis, not quite as concerning because the day sales outstanding or DSO and the cash flow from operations are not affected as the receivable remains on balance sheet. On the right-hand side, with a without recourse receivable sales, those are sold generally without, there's no risk of, the risk of default remains with the bank. And the accounting entry is a debit to cash and a credit to receivables. So the receivable is no longer on the balance sheet. And so the result of that is a cash flow impact is an increase to cash flow from operations. And this is where we then have to do extra steps to screening to do the analysis for the day sales outstanding and the cash flow from operations. And on the next slide, so in terms of what companies are required to disclose if they use these arrangements under IFRS, it's not quite as distinguished. So I would always recommend in cases for companies under IFRS that you ask the company if they're employing the sale of receivables. I mean, you can see here we've used an example from GAIA Group, which was on our biggest concern this year. So from their 2017 annual report, you can see highlighted. It's a very basic statement that trade receivables that are sold to financial service companies under factoring arrangements are derecognized or taken off balance sheet once substantially all the risks and rewards have been transferred to the financial services company. So this little piece of disclosure for us, piqued our interest, and we talked to the company about it and got them to disclose just a little bit more in their presentation. But this contrasts with what we see under US GAAP, where the requirements are more detailed, things like the policy, the amount, there's cash flow disclosure assumptions used for the retained interest portion, how much is outstanding, what proportion is recognized versus derecognized. And the accounting literature gives some fairly detailed sample disclosure in that case. We'll move on to the first case, which is on Kraft Heinz. And so in this paragraph, they talk about the carrying value of their trade receivables removed from their condensed balance sheet in connection with their sales programs was $1 billion for both 2017 and for 2016. And then the paragraph goes on to explain what they got in terms of cash. So in exchange for the sale of trade receivables, received cash of $673 million at December 30th, 2017, and $904 million at December 31st, 2016. And recorded sold receivables of $353 million at the end of December 2017 and $109 million at December 31st, 2016. So just to decode that very last sentence, this is the deferred purchase price or the beneficial interest that was retained by the financier. And if we go on to the next page, the table lays out for Kraft Heinz, what are we going to do with this disclosure? So we have it, what are we going to do with it now? Because here you can see we've laid out the $1 billion that was removed from the balance sheet on the first line. We've detailed here what the cash received was, deferred purchase price, which we went through. And on the second to last line is the reported DSO. So that is something that a screen would pick up just using the sales and the receivables that are on the face of the balance sheet. And that's 10 days for 2016 and 12 days for 2017. But what we would do is go a step further and add back what was removed from the balance sheet. And you can see that it makes a material difference in not the year-over-year change of the day sales outstanding, but it does make a material difference in the absolute amount of the DSO. And this is not something that screens are generally automatically able to adjust for. On the next slide, we have a second case study, which is DIA, which is a Spanish grocer with its presence in Iberia and Latin America, and also a name that we have written on extensively in the past. And oddly, they were selling receivables to the bank, and these were supplier receivables. This is also a tactic that another grocer casino does as well. And the disclosure goes through and talks about in 2016 that they entered agreements to transfer supplier trade receivables both with and without recourse, and goes through and details that the transferred receivables that had not yet fallen due at the end of December 2016 totaled 88.4 million euros, and all were considered to be without recourse. You can see in that table, we've put the cash flow from operations, which came straight from the statement of cash flow. And we've made an adjustment for those transferred receivables that are not yet due. So this increase of 88 million in supplier receivables they sold to the bank. And here you can see what the cash flow would look like using that adjustment. So again, not something that a screen is able to do automatically. On the next slide, in terms of this rule, this applies to companies that are under US GAAP only, and really kind of covers the securitization pieces of it, so that in the new rule, the cash received from the deferred purchase price or the beneficial interest, it must be recorded in cash flow from investing and not in cash flow from operations. So this is not impacting outright factoring. And the rule went into effect in January 1st for December year-end files, and companies may adopt early. We saw Kraft Heinz did that, and then actually had to restate for not properly implementing it. So I think Teva shows a good example of disclosure and what really the impact may be for some of the companies that you're looking at under this new rule. So in the highlighted section, you can see they've clearly laid out for investors the early adoption of this guidance would have resulted in a reclassification of approximately $1.3 billion from net cash provided by operating activities to the investment activities for the year ended December 31st, 2017. And that they expect this amount to increase going forward based on expected changes in their DPP, or deferred purchase price terms, and the volume of their securitization program. And they summarize that for you on slide 20. This comes straight from Teva's 2017 10K, some more detail on their sold receivables. And then on the next slide, this is a CFRA summary of what this looks like in terms of, okay, going forward, the impact is upfront cash remains in CFFO. Collection from the DPP or beneficial interest is going to be flowing through cash flow from operations. And on the third line, this is just a summary from the Teva example we gave. So reported cash flow from operations will go down about $1.3 billion for them in 2017 had the rule been in effect then. And I think we're already starting to see with the ASU 2016-15 that companies are already fine-tuning some of their arrangements to not be forced to implement the rules the same way. Nobody wants to take a $1.3 billion to their cash flow from operation. We've seen Kellogg's, Jabil, and Crown Holdings make some fine-tuning to some of those arrangements. So the second tactic that we're covering today is reverse factoring. And to define that, that's a sale of payables to a bank or financing company. And these are sold to a third party, and it helps the company's supplier finance their receivables. And the bank or the finance company will sit in the middle between the company and the supplier. And some terms that we use for these arrangements are reverse factoring, payables factoring, supplier financing, supply chain financing, and structured payables. But as with anything else, even using some of these terms may not always yield results. For example, Carillion, this type of financing was buried in their trade and other payables and was only able to be searched through looking at the transcript versus company filings. So on the next page, I think it's a good chart that lays out exactly how the mechanics of reverse factoring work, although it's quite a simplified example. But in the first step, the company will make the purchase from supplier and debit inventory and credit their accounts payable upon receiving goods as they would under a normal transaction. And in the second step, you can see the bank or financing source, after the company approves that this vendor is on the plan, would remit cash. And this is typically at standard vendor terms or even earlier, and give that cash to the supplier. And then lastly, the company will then, instead of paying the supplier, would pay the bank or financing source at typically a later date than what standard supplier terms would be. And I think also just in terms of the financing cost, we haven't put that in here, but it's not always clear cut that either the company or the supplier will be paying the discount rate for that. Even though the supplier is benefiting from the company's credit rating, it's not always clear who's bearing the cost of this facility. Why would a company do this? I mean, we have many examples of companies engaging in reverse factoring, many that we've written on both from company-specific, topic-specific, and industry reports. Kuehne Nagel, Telefonica, Zalando, Carillion, to name a few. And in the U.S., the same holds. General Mills, Kraft Heinz, and Conagra and Kellogg's are also some examples where we've seen people using this as a tactic to help delay payment to their suppliers without straining their relationship. We can move on to the first case study for reverse factoring. And I would say that this is really kind of the disclosure that you would hope to see as an analyst, because Kellogg's has very clearly laid out for you what the cash flow benefit is. In the highlighted section, they've said that it's about $210 million. On the next slide, this is a snapshot of analysis that we would do, just assuming Kellogg's had not provided the information they did on the previous slide. So how would we tackle this? A couple of ways. On the second line, you could see they do also detail how much relates to reverse factoring. And then on the third line, we would then think about, okay, well, what's the incremental amount that they have used for reverse factoring? The other thing that we would look at is the statement of cash flow. And I think just more generally for all companies, what does the accounts payable changes in working capital say? And this will give you a more general trend of a company's payables and how quickly they're paying suppliers, whether or not they may be engaging in reverse factoring. I think it's also particularly helpful in the cases of companies under IFRS to look at this, given a lot of them are not potentially disclosing reverse factoring. And then the last set of analysis is something that we do where we would hold the days payable outstanding at the same level as the previous year to see what kinds of benefits, if any, a company may be getting from both stretching suppliers, payment to suppliers, as well as engaging in reverse factoring. So on the next slide, this just shows you the difference between the three data points. I mean, we obviously have the benefit of getting from the company how much benefit they had from reverse factoring. So you can see that on the last line. But this just summarizes the other 2 points that we would analyze if we didn't have that disclosure. So General Mills, I think, is a situation where it's not exactly as good disclosure as Kellogg. So again, just to highlight how we would potentially use this information in doing our analysis. And they outline at the bottom of page 29, as of May 27, 2018, $936.6 million of accounts payable is payable to suppliers who utilize these third-party financing services. So on the next page, we go through again and look at, okay, what's the accounts payable on the balance sheet, how much relates to factoring, what is the incremental amount, and then we would also generally look at the statement of cash flow. I think unfortunately, General Mills' case, it's not very helpful because they've lumped together a bunch of changes in working capital, as you can see from on the third line from the bottom. And then the bottom line, we have held the days payable outstanding at the previous year to see what kind of year-over-year benefit the company may be obtaining. Under IFRS, I think we see more divergence in the location of the reverse factoring. Sometimes it may be in cash flow from operations, and sometimes it may be in cash flow from financing. And this is not something that regulators are completely unaware of. Even before Carillion, the European Securities and Markets Authority had met several times to discuss this issue, as well as the AMF highlighted this in 2015. So it could be that there may be post-Carillion more conversation on this topic. The last example, which is Sinopharm, is a pretty rare example. And you can see here they talk about in their annual report their accounts payable financing program, and that the drawdown of borrowings is a non-cash transaction while they repay the borrowing. So the repayment to the bank is done through the financing cash outflows. And the issue here, I think, it's complicated by the fact Sinopharm uses a direct method of cash flow. And so at any time, you can see here from the table, the CFFO has been increasing pretty rapidly. But if you go back into the payable financing program benefit, which is down in the financing section, and again, not something that's going to be able to be screened for easily, that adjustment takes down Sinopharm's cash flow from operations pretty significantly. And then here we show you some other analysis we would do for the factored receivables, and then also in terms of their interest paid, reclassifying that up into cash flow from operations. And you can see from 2015, what's reported is 13.6 billion RMB cash flow from operations. But after the adjustments that we would make, we think that number is closer to about 2.9 billion, which is quite a big difference. So on the next section, we're going to go through Kuehne Nagel, which is a Swiss-based company in the logistics space, with the thesis overview that the mid-teens revenue growth rate the company is experiencing has been driven by higher receivables growth, and that growth rate may not be sustainable. And secondly, that the cash flow from operations has been increasingly relying on payables growth, which is also likely unsustainable. And they've been engaging in supplier financing. So this is why we think is a good example for our webinar today. And then lastly, margins have continued to decline despite revenue and volume growth, as there's some supplier consolidation going on in the industry and more price transparency as well. And then here's some of the details related to Kuehne Nagel. And we added this in April of this year. And comps include Panalpina, Seva, and DSB. So on to the analysis. This information is coming, that you see here in the table, coming straight from the income statement and balance sheet from Kuehne Nagel. And the trade receivable DSO is rising. It's gone up 4 days year over year. And the deferred income, which is representing revenue which has been earned, but they can't reliably estimate, that is going in the wrong direction as well. And so when you put those two together, you're seeing a net DSO trend of year-over-year expansion, taking them longer to collect. In terms of the days payable outstanding, we're seeing an extension in the time that Kuehne Nagel is paying its suppliers. And while we could partially blame Kuehne Nagel suppliers for that, it's still a benefit that's going to end at some point. And the company has been clear that they are using supplier financing and have been since at least 2013. So with all this, I mean, how are these working capital trends affecting the cash flow from operation? I mean, even despite the extension of payables, we're still seeing that cash flow from operations is declining as they're not getting paid. And you can see the 125 million Swiss franc decline year over year. And I think also, interesting to note that the third line from the bottom of this slide, the operational cash flow, is a company-defined cash flow metric, which excludes working capital. So kind of touches on the non-GAAP adjustments that we tend to focus on with respect to cash flow. And then on the profitability side, Q3 of 2018, the company missed their EBIT margins. They missed consensus. The share price was down that day about 4%. And the profitability within the sea freight unit continues to decline. And lastly, we've included here a summary of management's commentary on the supplier financing. I mean, you won't find the reverse factoring mentioned in any of Kuehne Nagel's filings. It's quite similar to Carillion in that way, but they do mention it outright on the earnings calls. So I think it's important that this slide highlights that you can use this tactic for some time. It can go on, but eventually it will catch up. If you flip back to slide 39, I mean, as you can see here, the trade payables inflow from Q3 2018 was 41 million compared to a 256 million inflow a year prior. So definitely weighed on their cash flow from operation. And that concludes the content part of the session, but we're going to turn it back to Julian Sanguidolci for the Q&A session.
All righty, Jen, thank you very much. It was very great presentation. I thought those were some great examples. We did have some questions that came in while you were speaking, and we'll take as many as we can handle before the time comes up. So I'll just start here. Jen, the first question is factoring is a service a lot of firms utilize, so it makes some of these companies that you highlight so extreme in these cases.
I mean, I think, yes, there's a lot of companies that are using both forms of factoring, and I mean, what we tend to focus on is not where companies have been using the same amount year over year, but where there's changes at the margin, either where they've never been employing these type of facilities and now they are, or they're ramping up their facilities to the extent that the cash flow and some of the other metrics we discussed are quite distorted.
Thank you. Next question deals with factoring by region. So how does CFRA find the use of factoring by the various regions that you cover? So North America, Europe, and Asia differs, and where do you find the most aggressive behavior to be in what region?
So we are seeing factoring, I think it's across all the regions. I think the difference that we've seen more recently, just because of ASC 2016-15, is that in North America, the companies are tending to start to scramble to get around the new rule, either shutting down facilities or changing the way that they're structured.
On to the next question, deals a little bit more with our research output. So how many names do you publish on your biggest concerns list each year? And what is the duration each name stays on the biggest concerns list?
Well, we don't have a set amount that we're trying to reach. We're really just trying to pick the quality over the quantity of the names. And North America is our biggest region. At any one point in time, I would say we have probably 18 to 20 in North America, and that's at one point in time, and we have names coming on and off consistently throughout the year as things move. And then outside North America, the biggest concerns list is generally between 13 to 18 names. The duration varies. I mean, sometimes things play out quite quickly. That's one quarter, but then we have some names that are on for years as the downside risk remains and more games and shenanigans keep being played. But I would say, I guess on average, it's probably between 2 and 5 quarters.
Fantastic, thank you. So that was the last question, and that will be the end to our presentation. So on behalf of the team here at CFRA, we'd like to sincerely thank you for joining us today. Within the next day, you'll receive a note from us with a link to the replay of this presentation to review the session, and we hope you'll join us again for our next webinar in the near future. In the meantime, should you have any questions, please don't hesitate to contact us at cservices@cfraresearch.com. One last quick note, there'll be a survey that pops up after our session, and we'd love to hear from all of you and your feedback on today's session, and if there's any ideas you may have for future sessions, please do communicate those to us. Have a great day, everybody, and thank you again for the time.